So today we'll be learning the technical analysis concept. The first session you have experienced the intraday trade technique, and in that technique I have taken Gann angle concept, also the volatility trade concept. In fact, this is technical analysis is not a new subject. Many of you will be knowing this, and most of the traders, those who used to enter into the market in their early stage of trading, in their early days of trading, many used to learn these techniques. So technical analysis, the term suggests that since the future price is an unseen event, we do not know how the future will be, so we used to investigate on the past, and from there we used to draw some inference. Since future is not known and it will be always an unknown parameter, nobody can able to predict the future. Even the best astrologer in this world cannot able to predict the future. So the prediction of the future is totally, you can say, a vague event. You cannot able to predict the future. However, we can able to calculate the future. We can able to draw some inference for the future. So for that reason only all this study happens. And it is a very common thing. If you know tomorrow the Infosys stock is going to touch 5,000, then there is no fun in any of the study. So you can make money in market like anything. So always I used to advise people, do not run behind such kind of study. Do not have the attitude to predict the future. Rather you can calculate. Rather you can methodize your trade. Yes, you cannot able to predict, but we can able to get some inference from the past. We can calculate specific things. Yes, after this level of resistance, the demand side will be more, or the demand will supersede based on specific facts, based on specific research, based on specific fundamentals. So those research and fundamentals are known as your technical analysis, and it is a vast area of study. So it starts with your chart technique, it starts with your patterns, it goes to your statistical methods wherein we have oscillators and indicators. Then we have physiological studies wherein your Elliott, Fibonacci, Gann concept used to come. So there it ends. Then the risk assessment or the risk management comes in a second part of our second leg of our technical study, which is covering our option studies. So this is what the entire domain of our technical study is. So this is but we cannot able to cover the entire thing today. So today's event, how special it is, how different it is. I'll be going to tell you specific things on candlestick pattern. 2 to 3 patterns I will take. I'll be taking 2 best trend continuation pattern and trend reversal pattern, and I'll be covering couple of oscillators. And one of the very good news for the Indian traders, nowadays all these tools, most of these technical tools are given free of cost by the National Stock Exchange. National Stock Exchange of India is giving most of these tools free of cost. You need not have to buy anything. But if you have already bought any lakhs worth of software, then better use that. But if you do not have that software, those tools are nowadays available by the NSE free of cost. You can say there is a template like this. You can say in the NSE site you will find out one template like this thing. It has indicators, it has patterns, candle pattern recognizer. So many interesting features it has. Fine. So we will start our journey from the first itself. We will go to the study of our candles. Then, so normally the candlestick pattern, whenever we talk about, it is denoted like this. There is a thick stick-like structure and it has a thin stick-like structure upside and downside. This is called as a candle. So this is represented as this is the open price. This is the highest price of the stock at a particular time frame. This is the lowest price of the stock and this should be the close. And sometime this may be open and this may be close also. So the open and close represents the threshold point of your thick body, and the high and low are the threshold point of your thin body. This is known as your candle chart technique. So this thick body is known as your candle body. This thin body in the upper and downside direction is known as your upper shadow and lower shadow. So this is what the name of the candle or the candle represent this thing. And this candle has 13 different lines. Sometime the candle may not have the upper or lower shadow. Sometime the candle will have only upper shadow. Sometime it will have only lower shadow. So likewise, we have 13 different candle lines. And using these 13 different candle lines, near about 180 candle patterns are there. So you must say that whether I have to remember all the candle patterns and accordingly I have to work. No, you have to keep some reference book so that with the help of some software you will be recognizing some pattern. Once you recognized one pattern, or once the pattern is recognized by the software, so through that reference book you need to refer what will be your trade decision. So that is how you should apply the candle patterns in your study. So some reference manual is highly required, but if you are good at your memory is very strong, then it is not a big task. You can able to remember most of the patterns. So today I will be taking engulfing pattern, dark cloud cover pattern, morning star and evening star. So whenever this pattern forms, it is very simple to understand certain structural arrangement of the candles. So the first structure is a bullish engulfing pattern, which says that the first candle is a falling candle, means it is represented as a red body or sometime it is a black body, and the second candle is represented as a blue body or a white body, whatever may depend upon your software. However, one thing you have to very carefully remember, the first candle must be totally within the second candle, then only it is known as the engulfing pattern. Once you identify this engulfing pattern, whether it is bullish or bearish, there is a mathematics behind it. So it happens, this is the first day candle or first day, and the second candle, it may be represented as the second day, or the first 15 minute and second 15 minute, or first 5 minute or second 5 minute, based on your requirement. Once you identified this pattern, then the mathematics comes into picture. So this pattern, not only candle pattern, for all patterns, it has to give a breakout. Once the breakout happens, you need to enter a trade. Then you need to know where the breakout will scale, or where the breakout will take you from that point. So the migration point from the breakout till the final journey is known as your target identification. So for this engulfing pattern, second day's high added with 0.786 Fibonacci ratio of the second day's high to low price range will give you the pattern breakout. Target identification, initial target used to be 1.272 retracement of the price range, and it should be added with your second day's high. So this will give you the first target, and this is having a ultimate. The next targets will be much higher, and it can continue till any bearish engulfing or bearish candle pattern is not formed. And it used to give the failure also. So second day's low minus 0.786 retracement, if it is scaling, then you can say the pattern has failed, and you need to derive the same way the targets from the failure point. Same logic holds good for your bearish engulfing pattern. And here the volume action is also prominent. So during this formation of engulfing pattern, the volume used to be moderate. Whatever the previous volumes are there, it will maintain. Once the pattern breakout will happen, you will find out a sudden spike in the volume or sudden rise in the volume. So this is what the pattern says. So we'll just see with one intraday confirmation. Today you can say Bank Nifty, I'll be taking, instead of historic data, I'll be taking the intraday data. So 15 minute. So for 15-minute intraday data, I have taken for the Bank Nifty. So let me see whether any engulfing pattern I am finding or not. So once the engulfing is formed, then based on the mathematics, whatever we have learned, on that basis we will be initiating the trade. So here, as I told you, you have specific NSE site is giving you one opportunity to identify those patterns, but specific errors are there. Those errors can be rectifiable. You can say in this you have many patterns. However, there is a parameter fixing is here. So that parameter fixing, if you can do it properly by referring through some standard book, then this feature can identify the patterns very accurately. Like once the pattern is identified, one mark you will get here, and it is showing that dragonfly doji has formed on 31st around 12 noon. Dragonfly doji, and that same also corresponds to gravestone doji. That same also corresponds to doji. However, because of that parameter I have not set it properly, because that is a default parameter setting they have done. That's why you are seeing such kind of action. So now let me examine my study. So bullish or bearish engulfing pattern. So this is the only one. So this is the only one pattern I'll be taking for you, and other things I'll just take from the theoretical perspective view. So This only one pattern I will take in detail. So you can say, as I have told you, the first candle must be engulfed totally within the second candle. So then only you can say engulfing. Whether this 15 minutes, these two candles are engulfing, this is engulfing, these two candles, whatever you are seeing here, whether it is engulfing, no. The second candle must be a higher candle, and the second candle must engulf the first one. Means the first candle should be within the second candle, then only you can say it is engulfing, otherwise not. So this is not a engulfing. Then we have come to, and both should be in opposite color. One is a falling candle, means other should be a rising candle. So that is the criteria of the engulfing candle. So now then we have come across to one more candle, one more thing here. So whether this one is an engulfing candle, this we need to investigate. So both are opposite in color. We need to investigate the high and low, which is corresponding to these two candles. So this first candle high is 11,855, low is 11,836, and second candle's high is 11,865, 10 points more than that previous high. Low is 11,835, so 1.15% lower than that. So this classifies to be a engulfing pattern. Then the second part comes into picture, whether it is a bullish engulfing or a bearish engulfing. So this classifies to be a engulfing pattern because the second candle is totally within the first candle. So this we have classified as a engulfing pattern. And the first candle is a red candle, means a falling candle. The opening is lower than the closing. So whenever the closing is lower than the opening, closing is lower than the opening, then it is called as a falling candle. Whenever the closing is higher than the opening, that time it is classified as a rising candle. So this is a falling candle and this is a rising candle. So engulfing, rising and falling candle we got. So let us put those values. So we have identified those pattern. Now let us put those values and do some calculation and find out based on the things whatever we have studied for engulfing. So 1130 candle is giving us this opportunity. So 1130 candle, 11,855, this is the high, 11,836.15 is the low, and 1145 candle, this gives me 11,865 as high and 11,835 as low. So this is low. So bearish engulfing. So this is the bearish engulfing I have concluded. So between the high and low of the second candle I have 30 points. So 30 points is the distance or the price range here, 30 points, the second candle. So it is, though it is an intraday candle, so though it is an intraday candle, so here after 30 point estimation I have done, breakout I have to find out. So my reference manual has given me the breakout 11,865, which is the high, added with 0.786 times of 30. So this will give me 11,888.6, above which I will say that trend is up, and I can buy the counter for a target of 11,865 added with 1.272 times of 30. So this will be giving me 11,903.16. Breakout, above this breakout I can say, so 11,835 is the low of the second candle, subtracted by 0.786 times of 30, which is giving me 11,796.84. If it is falling below this, you can say pattern has failed. Pattern has failed. So pattern has failed. Sorry, this is the bullish engulfing, not bearish. Bullish engulfing. First one is a falling candle and second one is a rising candle. So it is a bullish engulfing. So bullish engulfing pattern, first is a falling candle and second is a rising candle. So it is a bullish engulfing. So above 11,888.6 trend is up, and below 11,796 this pattern has failed. The bullish trend what I have identified, it is failed, and now it has to fall further, and the falling tendency also I can calculate like 11,835 subtracted by 1.272 times of 30, this I can do. So if the pattern failed, I can have this kind of targets also. What happened afterwards? Let us see. So this is what we have identified. Bullish engulfing pattern. So bullish engulfing pattern. So next was a doji. So doji line 11,859. It has closed 11,859. So our buying price is 11,888. So 28 points now we are below. So we have migrated to here. So the very next candle, which is 12:15 time, 11:32, 11:45, the pattern has formed. By 12:15 candle, we have, it is very much visible that opening was 11,886. So you got a chance to purchase. However, we are not fortunate enough. So it has just made a high of 11,898, 97.9, rounded to 98, but failed to touch the target of 11,903.16. So from there it has fallen. So this is how only 3 to 4 point it has lagged from that point, and it has fallen. And very next point, we have very much got the chance that the pattern has failed after an unsuccessful attempt to make touch the first target. Those partially or 90%, 95% it has touched the first target, but it failed to penetrate that target and fallen below that, dragged below that, and the pattern has failed. And we have estimated if it fell, then it will, the failure point is 11,797, which in fact fallen by 12:45 time. So once it is falling below 11,797, it has all probability to fall till 11,762. So which is very much achieved in that same candle itself. So this is a very small demonstration for intraday trade, but candles are not that much successful for the intraday trade. You have many better and improved method for that. Just to explain the concept, I have given this thing. However, this can be used for your short-term trend identification. Short-term trend identification. So for making a short-term trend identification, you can, instead of taking the intraday data, you can very well take some historic data for monthly or some instead of daily, weekly, monthly. So you can choose the data sets and take some longer data sets and use the candle concept. It can easily give you the trend points, and it can be much more accurate than your moving averages. So candles are more accurate as compared to the moving averages. So that way you can use the candle. So I concluded here that first, in the candle technique, first you need to identify the pattern. Once the candle pattern is identified, then you need to find out a breakout. Once the breakout is identified, then based on specific mathematical calculation, you have to identify the targets. But none of the software will give you the breakout and targets. Breakout and target is your job. They can only identify the patterns and can give you. However, you can, those patterns, whatever you have seen in the NSC site, there are some little bit of adjustment you have to do in the parameter so that it can give you correct recognition, because that is default settings are there. So you need to change those settings. So that part I will not be taking now. So this is what your engulfing pattern is. Similarly, we have one more pattern, which is dark cloud cover. So it has same kind of two candles. So bullish dark cloud cover means the first day will be a falling day. So first day will be a falling day, or the first candle will be a falling candle. Second candle must have this kind of nature. Gap down opening means wherever the first candle is closing, much below that the second candle will open. So it will have a gap down opening. So opening and the closing of this first candle should have sufficient gap, and it should close as a rising candle. So falling candle followed with one rising candle. However, the rising candle must have a gap down opening as compared to the falling candle. So that classifies to be a bullish dark cloud cover pattern. Similarly, you have a bearish dark cloud cover pattern. So first body will be a rising candle. Second body will have a gap up opening. Gap up opening. The opening will be gap off. However, it can close within the body of the first candle. So that is called your bearish dark cloud cover. So what is the mathematics behind it? So the mathematics of this pattern is first day's high plus difference between the first day's high and second day's close. So first day's high pattern breakout is the first day's high added with difference between the first day's high and the second day's close. That difference need to be added to give you the pattern breakout. And target identification, it has an unlimited target till there is no bearish candle formation pattern is not formed or doji formation has not happened. If any doji is formed, we have 3 to 4 different kind of doji. One is a simple doji, then dragonfly doji, then we have gravestone doji. So 2 to 3 types of doji. If that doji line is forming, then we can retire and we can say that yes, we have now the trend change can happen. So target is unlimited, but you have to very closely have to observe. There should not be any doji, and there should not be any bearish formation, bearish candle formation on the chart. So till that point it will continue. So this breakout is very crucial. And pattern has a failure also if the price moves below the second day's low and close slightly above the open we'll say this pattern has failed. So this is the three important aspects of this bullish dark cloud cover, and same holds good for the bearish dark cloud cover pattern. So bullish and bearish dark cloud cover pattern. So you have to identify the pattern, and you need some reference manual from where you can get those mathematics and apply those things on your trade. Then we have morning star and evening star. So this pattern have a black body open with, and the second will be open with downside gap, but this candle's color is not that much important. So here it may be a falling candle, it may be a rising candle. So this is not important for us. So second, only we have to see downside gap. So first candle and second candle should have a downside gap. So downside opening as well as closing, downside opening as well as closing gap. So third candle open with a offside gap as compared to your second candle, and close as a rising candle, and it must be within the first candle's body. It must be within the first candle's body. So it should not cross the first candle's body. So all this, it must be within the first candle's body. If that happens, then we can say it is a morning star pattern, and this is a bullish pattern. Evening star is a bearish pattern. So similar kind of arrangement of the candles, but it must have the opposite nature. So it too have a mathematics associated with this. So morning star and evening star, this pattern's mathematics already I have given in our website smartfinancein.com under the articles link. You can just visit those links, articles link. You will get the complete mathematics of these two patterns. So you understood the patterns can be recognized with the help of specific software. Once the pattern is recognized, then you need to use specific reference manual. From there you have to take the mathematical aspect of it and apply it for your trade practice. This is what the pattern of our candles. Now I will move into the oscillators and indicators. So here I have just taken off two oscillators, Bollinger Band and RSI. So Bollinger Band, most of you will be using it. So because this is the only one indicator which uses the standard deviation or the volatility. So none other than this is using, or none of the other indicators available in our technical domain. We have near about 3000 plus indicators, but none of the indicator is using the standard deviation or the volatility into its calculation, or except this Bollinger Band. That's why this is very, very successful indicator. Bollinger Band, the standard deviation and the volatility already you have learned in the previous session. So here it has three bands. One is the middle band, second is the upper band, and third is the lower band. Middle band is nothing but the moving average or the simple moving average. So it will have this kind of structure. So three bands, middle and upper and lower. So middle is just for your, it is the reference line. Once the price move above this middle band, you can say that trend has changed and the trend is going to touch the upper band, or the bull trend will take the price to the upper band. Once the price is falling below this middle band, you'll be sure enough the trend is now down and the trend is going to take the price till this lower band. If the price is hovering near to this upper band, then it is overbought. If the price is hovering near to this lower band, then it is called as your oversold region. So overbought, oversold, trend recognition, these two benefits you are getting from this Bollinger Band. Not only these two, it has some more benefits also. So this, you can say, this is just like a hollow pipe. You can say it is sometime this, the diameter of this hollow pipe is small, and sometimes this hollow pipe's diameter is more or expanded. Whenever these bands used to contract, means bands used to come closer to each other, so you can say the trend is saturated and it is going to change in future. Trend is saturated, so trend saturation point also you can able to find out from this narrowness of the band. Once it has expanded, trend saturation point you can find out. Once it is expanded or diverse from each other, and this diameter of the hollow pipe is increasing, you can say that some trend change is expected. So saturation of trend, change of trend, identification of the trend, these are the, and overbought and oversold condition of any price. These are the 6 different benefits you can find out from the Bollinger Band. So I'll just show it in this NSE platform. So here we have the indicators. So Bollinger Band I have taken. So Bollinger Band. So it has specific parameters. So those default parameters, let us hold to those default parameters, and so let me so rather we can take the daily, intraday, 15-minute, and we can plot it. So this Bollinger Band, we will see how those hollowness and expansionness of those bands are affecting our trade. So 15, so this is default, it is being set as 30. We can take it as 15 minutes. So 5 minute also we can take. So we can say this is the 15 minute. Let me take the 15 minute. So the first, this upper and lower are the Bollinger Band, and middle one is a simple moving average. 5 period. So 5 period simple moving average we have taken. And this Bollinger Band has specific settings. So as I told you, this is using the volatility. So by default it will take 2. So it will take the volatility as 2, and you can change it. You can change this factor to some lower value or some higher value also. You can change this band's standard deviation factor, and here I have taken 5 period. So 5 period Bollinger Band for intraday, and 20 period for the positional perspective. It is the standard, and standard deviation is being used as 2. So we can change it. We can also change this, the standard deviation factor. So once you will take it here, so you can just see the Bollinger Band is narrowing here. So this particular point, it is, you can say, so the band has narrowed down here and it has expanded maximum here and this page. So whenever the narrowness is coming, the trend change is expected, or the trend is in the saturated trend, and maximum expansion stage, the trend will change. So here the first page place the narrowness of the trend, it is saturated. So you can say you have Bollinger Band which is started from this point to this point. It was the narrowness of the band was continuing, and here you have expected the trend change, and it was the overbought region you are at this point of time, and the middle band has broken and it has fallen below the middle band and it has come to the oversold region. So this oversold region was continuing, and simultaneously the band was expanding. And once the band has started contracting here and the middle band crossover has happened here, so trend is saturated and middle band crossover, and this band, after a prolonged expansion it has started contracting. Trend change has happened. So trend change has given the confirmation here. Once the price move above the middle band, and the trend change confirmation followed with one saturation of this trend has given, and after which you have found out a uptick and it has settled here, and this also corresponds to your overbought region. So this I have demonstrated in the intraday chart of Bank Nifty. Similarly, you can use for the positional perspective also, and you can identify the trend for the weekly or monthly or daily data. In that you can use 20 period Bollinger Band. Here 5 period is being used, so you can use the 20 period data there. So the 20 period data will give you the exactness of the Bollinger Band. So here too you can change the values. You have the procedure to change. Since I have lack of time, I cannot visit to those things. So how to make the changes? Just spend some time in the NSE site, you will get to know. So now I'll come to the relative strength index and RSI. This is known as your RSI. RSI has a formula. So 100 minus 100 divided by 1 plus RS factor. RS factor can be calculated as average gain and average loss. Average gain divided by average loss. So from this you will be finding out the relative strength indicator, and this is why this RSI is being chosen by me, and I used to say that this is one of the best indicator. The reason is this is the only one forward indicator available in the technical studies. So this is known as the forward indicator. All indicators are called as the lagging indicator, and RSI, relative strength index, it has a value scale from 0 to 100. So 70% to 30% are used as the warning signals in the RSI. 70% consider as overbought, and below 30% or 30% is considered as the oversold. And for making investment decision, 14 days RSI is being used in the intraday. Some used to apply the 7 period RSI. 7 period RSI is used in the intraday, and 14 days RSI is being used in the for making positional trade specific decision. So this is what the RSI says, and it is one of the easiest indicator, and that too available in that NSE domain. If you visit to that and spend some time there, you will definitely get those things. And if you wish to apply in your Excel sheet, you can do in this order, not in the percentage terms. So closing and previous close, take how much in the monetary gain the stock has given and how much the monetary loss the stock has given. Then you have to take the average gains and average losses. Then you have to find out the first RS and smooth RS. So first RS is nothing but your average gain divided by average loss, and RSI formula I have told you. So using on that RSI formula, you will get to know the RSI factor. And once you have 100 minus 100 divided by 1 plus RS. So once you have got this RSI, based on the 30 and 70 parameter, you need to decide whether you are in overbought or oversold region. So this is what if you wish to do in terms of your Excel sheet. So these two concepts we have taken. The last concept I will be taking the chart patterns. Before that, so that too in a mathematical point of view we will discuss. So before that, spend some time to know about the smart finance, its activities and its products.
Thank you. Our paid products are as follows. We have total 7 varieties of products, namely investor course, technical course, Elliott wave, Fibonacci, Gann, future and option and volatility. Each of these courses contains 3 DVDs and 1 book and 1 software. And the prices are as given here, 1500 each cost, and future and option will cost you 1700 and volatility is another 1700. There is a discounted price. Instead of 10,900 it costs you 8,100 rupees, which includes all the materials given above, that is 18 DVDs, 6 books and 5 softwares. Our today's topic of discussion, if you want to learn in detail about the various technical analysis subjects, you can go for our technical course, which avails you 3 DVDs and 1 book, and it costs you 1,500 rupees. There we give you the mathematical derivation of each of the technical analysis concepts, all the chart pattern, all those things. Mr. Ranjan has given how mathematically you can derive these things and how you can apply it in Indian stock market. With Indian market frontline examples, we have explained this concept in detail in this course. The following event, we are going to have one paid webinar, online seminar. It will be a 12 days program starting on 23rd of April 2011. Here we will be giving you 7 days lecture session of Mr. Ranjan with 5 days practice session during market hour. So those 7 days we will be giving you the recorded lectures of Mr. Ranjan, where during the daytime any number of times you can listen those recordings, and it will be uploaded in the e-platform. So there is flexibility of accessing those links during the daytime. Anytime you can access the link, and as per your convenience you can listen the theory sessions. And 5 days practice session will be 11 a.m. to 12 p.m. in the market hour, where live telecast of live transmission of the program will be happening from Chennai Smart Finance. And the topics are included: best principles of day trading, then win the trade using hedging principle, and financial arithmetics for investors. So there is a fee structure, 8,000 rupees without any material, or you can have all the material with the program at 13,000 rupees. 13,000, it includes 8,100 worth all stuff of material, just now what I explained. There is a discount of 500 rupees available till date, till tonight. By 31st March it's getting over. For any query on this program, you can call to our given number 98403 48971 and 044 6499 5823. This is a purely online program, so the candidates do not have to travel all the way to our venue. By sitting at your place daily, by spending 2 hours or 1 hour, you can you can be exporting these techniques and directly listening to the master's lecture. And in 12 days, theory as well as practice, both you can cover by sitting at your place itself. Any question regarding the products?
Chat box. If the time permits, I will go through it. Since today's session was a long session and we have lot of topics, so it will not be possible for me to attend all the questions. However, I will try to attend all the technical questions. So understanding the chart patterns is the last part of our event, today's event. So two best trend continuation pattern and two best trend reversal pattern we will be discussing today. Trend continuation patterns means here whenever we talk about the patterns, Elliott wave also has patterns, Fibonacci also has patterns, candlestick also has patterns. So how different these patterns are from the pattern what we are going to learn now. These are called as your linear patterns. Linear patterns. So these patterns are not depend upon any kind of chart structure. You may take OHLC chart, you can use candlestick chart, you can use the linear chart, line chart. So they are independent from the chart. So these are called as our linear chart patterns or the basic chart patterns. So whenever we talk the candle chart patterns, that time only the pattern which is associated with the candles, how the first candle and second candle look like, how the first, second and third candle look like, how the first, second, third, fourth candle look like. So based on that, candle chart pattern is formed. Elliott wave pattern, how the wave is formed, 1 2 3 is formed, or 1 2 3 1 2 3 is continuing for 3 times, or first one impulsive, then one corrective, then one impulsive is formed. That is called as your Elliott patterns. So and Fibonacci pattern, whenever we are talking about some retracement we have given 0.618, then there is a counter retracement, again forward retracement. Like this way, that also forms specific patterns. But these patterns, what we are going to learn now, these are quite different from those patterns, and these are called as your pictorial view. You can view the chart and from there you can identify these patterns just by visualization. So something I will just say about this pattern. The first thing is minimum how many candles are needed to identify the pattern. This is the common mistakes people used to do. Even the experts used to do this mistake. How many candles I should take for identifying this pattern? I have done a lots and lots of hunting. Over the years of hunting, I got those informations, and I think it has taken the maximum time of mine to identify and summarize those facts which I have questioned here. How many candles you need to identify the pattern if it is a candle? And most of the times the candle is being used for identifying the pattern because it is easy to identify the high and low and easy to calculate those levels. And second, pattern which will not work in intraday chart and which will work in the intraday chart, that is also being ignored by the many of the experts. Certain patterns will never work in the intraday. Certain patterns will work only on intraday chart. So what we have done here in our initial days of research, when we have come with only few course things and some you can say seminar events in the year of 2005 on technical analysis. So those are the initial days of our smart finance. But those days we have done lot of works in this part. What we have said every pattern is having a hidden geometry, and which is difficult to decode. In fact, it is very, very difficult to decode. And pattern speaks the behavior of the traders. Hence, it must be mathematically validated. The pattern, the chart, what the shape the chart is taking, it is not by me or it is not by a couple of traders. The total involvement, market involvement is giving that shape to that price movement. So price and time graph, it is taking one shape. So it is the behavior of the traders and it must be validated with mathematically. This is the second argument we have put forward, and we too have found out specific conclusion for that. And third, from various literatures we have found out nobody has invented this pattern. These patterns of your flag, pennant, head and shoulder, double top, double bottom, triple top, triple bottom it is not being invented by anyone. It is being invented by the people. So that is the greatness of this invention. This is the only one invention in the technical domain which has happened not by a single person. It is by a group of person, or it is a wide group of person. Through word of mouth it has spread it, and after then it is being decoded. Nobody has named that yes, flag is being invented by Ranjan. Nobody has said that yes, double top is being invented by this X and Y. It is by the traders, and it has spread through word of mouth, and it is being documented by the writers. So this is the third clue what we have got. And fourth clue we have found out while investigating on this W.D. Gann study. He is the man who has mathematically validated most of the patterns. And mathematically through his Gann angle trend lines, which is saying that different trend lines you can draw in different angles. With the help of those trend lines, he has validated most of these linear patterns. This is how this pattern arithmetic became different for us. We have understood in a different way. That's why we never speak the pattern in a very vague way. By seeing the chart, we never speak that yes, this is a flag pattern and this is going to give you a breakout at 5,880, break below at 5,770. Such kind of comments we never gives. Rather, we always says to the trader, follow one proper mathematics and investigate it. Do not accept our mathematics just like that. Investigate it, whether it works or not. So I am just going to take this first pattern, flag pattern for you, which is a trend continuation pattern. So it will have a structure like this. If you can draw these two trend lines, it will be almost two parallel trend lines you can draw. And this trend line, after drawing this part, the high and low, this is known as the height of the channel. This is called as the flag channel. And height of the channel is known as, this part is your flag pole, and this is the height of the channel. So once this flag is identified, what is the mathematics behind it and how many candles we require? So first, the rules part comes into picture. At least 8 candles should be taken to validate this pattern. In daily, weekly or monthly price chart, at least 8 days, 8 weeks candle must be taken to validate this pattern. And flag channel must be formed in 4 different price points. So you cannot form flag because without 2 lines, without 2 points, you cannot draw one line. So with the help of 2 points only you can draw. This is the point. This is the point you have taken. This point may little bit go up or go down. So here too also one higher rule is there. So just ignore that. However, these 2 trend lines. So for drawing these 2 trend lines, at least 4 price points, valid price points on the chart which has already happened you require. So that is what I am telling. 4 different price point, valid price point which has already happened on the chart on the past scenario must be taken. And the trend line forming the flag pattern must be parallel. So if they will not be parallel, then they can be considered as a wedges, or it may be considered as a triangle, but it may not be a flag. So how this flag used to give the breakout? At the height of the channel to the last high, that will give the flag breakout point. And if the breakout happens, the flag high added with the height of the channel will be the target. So just see this picture. So this is the very simplest mathematics. So you can say this is the last high. Once this will be added with the height of the channel. This is the height of the channel. If this is the added with the height of the channel, then this will give you the breakout. This is the breakout. If the breakout happens, the highest high, which is from where this flag has formed, this highest high added with the height of the channel, this will give you the target. This is the logic behind your flag pattern, or this is the mathematics behind your flag pattern. You can use the Fibonacci in between also to know the intermediate targets. Similarly, you have the bullish and bearish flag. Two kinds of flag is there. So the flag what you are experiencing here, it is tilting towards the right hand side. So this is a bullish flag formation. Tilting towards the left hand side, this will called as a bearish flag pattern. So bullish and bearish are two different type of flag formations are there. Now we have other linear pattern which is known as a cup with a handle, cup and handle formation. So prices will fall from a bottom and then after it will just go off to the first high, but the highest point from where it has started the correction, and it will again go up and meet the previous same high. After meeting this highest high, it will have a simplest correction here, and that will form the handle. Just give me couple of seconds. Just give me couple of seconds. I'll come and join with you. Sorry for the interruption. So here, so this is called as a cup and handle. So this is a beautiful pattern, very, very beautiful pattern for the long-term trend. Those who are the investors, those who wish to make some long-term trade investments, they can follow this pattern. So certainly what used to happen whenever you can say, consider the stock JP Associate from 160 level, it has come to 70 level. So if this is the thing has happened, and again if it is going to 160 level, so this completes one cup formation. Once this cup formation has happened, then it is the probability is it can form a handle, it can form a another type of inverted cup, and this may lead to head and shoulder formation. This may expand and form a head also here. So after this previous high is attended, carefully we have to observe what is the price action is. If this is going to form a handle, and this handle must be a flag or a pennant. If it is a flag or pennant, if you observe these things to be this handle is to be a flag or a pennant, then you rest assured the stock is going to create new highs and the higher highs, and it is going to be re-rated from here. Once this handle is completed and formed, wait for the handle breakout and purchase this stock, and it will give you very good return in a very short span of time. So this is how the pattern looks like. What is the mathematics of this cup and handle? So what is the mathematics behind this cup and handle. At least it should take 21 candles. At least 21 candles is required. And retracement of the handle must be less than 1/3 of the cup height. So whatever the cup is formed, whatever the price it has formed this cup, because from a high it has formed a low. So from high to low, whatever is the thing is there, 1/3 of that height may form the handle, and it can be a flag or be a pennant. And if the retracement is more, then it may lead to a double bottom formation. That is also probability. And handle formation should take less than 1/3 of the time taken to form a cup. But if it has taken 1 month, the handle should take only 10 days to complete. And volume also has some significance here. So, but you may ignore the volume here, because here your objective is for the investment. And pattern breakout means cup high plus handle height, handles height, whatever the handle height is there, flag height is there, that you have to add with the cup height. It will give you the pattern breakout. And once the breakout happen, the breakout point plus cup height will be your ultimate target. So you can say from 160, if you have fallen to 70, so you are having a 90-point gap here, 90 point of price oscillation here. And if you are having a breakout at 170, ultimate target will be 170 plus 90. So this is the price point where you can target. And this target will be achieved with the advancing volume, with the, you can say, in the less time, 2/3 of the time as compared to the cup formation. If cup formation has taken 1 month, then within 20 days you can achieve this thing. So this is the mathematics of your cup and handle formation. So similarly, we have trend reversal pattern, head and shoulder pattern, left shoulder, right shoulder and head, and left shoulder. So the left shoulder height is left high minus support 1. So here this bottom minus high will be the height. Right shoulder and support 2 will give you the height of the right shoulder. Head height will be from the support 2. It will be head high minus support 2 will give you the head height. So pattern breakout, and this is known as your neckline. So head and neck. So this is right shoulder, left shoulder, head and neckline. If the price fall below the support 2 with volume, so if this support is broken, and you can say that it is the head and shoulder formation is given a pattern breakout. It is a trend reversal, means if it is giving you this kind of formation, then the prior trend was an uptrend and the future trend will be a downtrend. So that's why it is named as a trend reversal pattern. So targets will be pattern breakout minus head height. This is how you can say, and this cannot be used for intraday. Head and shoulder, though many of the analysts are saying that now it is a head and shoulder, use it for intraday. This must not be used for the intraday. Cup and handles should not be used for the intraday. Inverted head and shoulder should not be used for the intraday. So these are not the intraday patterns. This is only for the investment trend decisions. However, the patterns big W and big M are the patterns which you can use for intraday. Big W and big M. So it is a bearish trend reversal pattern, and on this big W and big M pattern already I have given the literature under the article section in our website. You can just refer to that, you will get to know about those mathematics. So this is about trend reversal and the trend continuation patterns. So we have understood candlestick, how to use the candlestick in our study. We have understood how to use the indicators in our study. We have understood how to use the patterns in our study and how to identify the patterns correctly and what is the mathematics behind those patterns. So this is how we differ from the others while talking on the subject of patterns. So with this I will be ending today's session. So before that I will just go to the question and answer session and I will attend couple of questions and I will end with that.